and that's when they flipped. December 2025. While you were wrapping Christmas presents, JP Morgan closed the largest short position in precious metals history and went net long for the first time in decades. Not hedging, not reducing exposure. They switched sides completely. And if you don't understand what that means, let me be very clear. The bank that spent 15 years suppressing silver prices just bet everything that those prices are about to explode. 750 million ounces. That's how much physical silver JP Morgan now holds in private vaults. To put that in perspective, global annual mine production is 880 million ounces. One bank controls nearly an entire year of worldwide silver production. And they accumulated every single ounce while simultaneously running a 200 million ounce short position that kept prices artificially low. This isn't speculation, this is documented. The Commodity Futures Trading Commission data shows that for the first time in recorded history, U.S. banks as a group are now net long in silver. Not neutral, not balanced, net long, betting on higher prices. And JP Morgan, the largest player in that group, led the charge. But here's what makes this a betrayal. For 15 years, JP Morgan was the cop guarding the dollar. They were the institution that sold silver every time it tried to rally. They were fined $920 million in 2020 for spoofing and manipulation, the largest precious metals penalty in history, for rigging these exact markets. And now they've abandoned that role, taken their massive accumulated position, and left every other institution that was short silver completely exposed. The question isn't whether this is significant, the question is why now? And I'm going to show you exactly what JP Morgan saw that made them throw away 15 years of strategy and bet against the dollar system they helped build. Let me give you the framework for understanding what just happened, because this isn't just about one bank changing positions. This is about the architecture of the entire precious metals market collapsing and being rebuilt in real time. There are three players in the modern silver market: the producers, mining companies that extract silver from the ground; the users, industrial manufacturers who need silver for electronics, solar panels, batteries, medical equipment; and the manipulators, large banks that trade massive paper positions to control price while accumulating physical metal. For the last 15 years, JP Morgan has been the king manipulator. Here's how the scheme worked. They would hold enormous short positions in COMEX silver futures, contracts betting that prices would fall. Every time silver tried to rally, JP Morgan would dump contracts into the market, creating artificial selling pressure that pushed prices back down. They did this so aggressively that they were caught and fined multiple times for spoofing, a form of market manipulation where you place fake orders to move prices. But while they were selling paper contracts with their left hand, they were buying physical silver with their right hand. Between 2011 and 2025, JP Morgan accumulated somewhere between 750 million and 1 billion ounces of actual physical silver. They bought it at suppressed prices, prices they themselves were suppressing through their short positions. It was the perfect crime. Keep prices low with paper manipulation, buy physical metal cheap, wait for the inevitable shortage, then flip sides and profit from the explosion. And in late 2025, they flipped. Between June and October, JP Morgan closed approximately 200 million ounces worth of short positions. They stopped selling, they stopped suppressing. And for the first time since anyone can remember, the biggest bear in the silver market became a bull. What happened next was predictable. Silver, which had been trading around $23 per ounce in early 2024, exploded to over $80 by December 2025. A 250% gain in less than 2 years. Gold hit all-time highs above $4,500. The entire precious metals complex went parabolic the moment JP Morgan stepped aside. But here's the betrayal. JP Morgan didn't warn anyone. They didn't gradually reduce their position. They didn't give other banks time to exit their own short positions. They just pulled the cord and watched everyone else fall. Other institutions, HSBC, UBS, smaller regional banks, were caught completely offside. Many of them had been leasing silver from JP Morgan to run their own short strategies. When JP Morgan flipped, those banks suddenly had to source physical silver to cover their positions, but JP Morgan had already bought most of the available supply. It was a rug pull on an institutional scale. Reports surfaced in late 2025 of major European banks pulling $17.2 billion from the Federal Reserve's emergency repo facility in a single day, the financial equivalent of a panic button. Banks don't access emergency Fed liquidity because business is good. They access it because they're hours away from a margin call they can't meet. And while I can't prove which specific banks were in trouble, regulators don't disclose individual positions. The timing was impossible to ignore. Silver spiked. Repo facilities spiked. And suddenly, 4 major South Korean banks announced they would no longer sell physical silver to retail customers. Not limited sales. Complete halt. Indefinitely. That doesn't happen because of a policy change. That happens because banks can't source the metal. Now let me show you what changed in 2025 that made JP Morgan abandon 15 years of strategy and switch sides. Because this wasn't a whim. This was a calculated response to structural changes in the market that made their old playbook obsolete. First, industrial demand hit a tipping point. Silver isn't just a monetary metal. It's the most conductive element on Earth, essential for electronics and increasingly critical for green energy. In 2025, global solar panel installations accelerated dramatically. Each gigawatt of solar capacity requires approximately 2 million ounces of silver. The world added 500 gigawatts of solar in 2025 alone. That's 1 billion ounces of silver demand from one sector. Electric vehicles? Each EV uses about 1.5 ounces of silver in electrical components. Global EV production is projected to grow by 25 million units annually by 2030. That's another 37 million ounces of annual demand that didn't exist a decade ago. Samsung announced solid-state battery technology using silver carbon anodes. Their production target for 2027 is 200 million units. Each battery requires 1.5 ounces of silver. That's 300 million ounces of new annual demand from a single product line. Add it all up, and industrial silver demand is about to exceed total global supply. There won't be surplus metal left for investment, and JP Morgan saw this coming years ago, which is why they were stacking physical while keeping prices suppressed with paper shorts. Second, the paper leverage became unsustainable. The COMEX silver market operates on fractional reserve principles. For every ounce of physical silver in registered inventory available for delivery, there are an estimated 250 ounces worth of paper claims. Futures contracts, ETF shares, unallocated accounts. It's the same scheme banks ran with gold before Nixon closed the gold window in 1971. That leverage works perfectly until people start asking for physical delivery. And in 2025, delivery demands spiked. Registered COMEX silver inventory, the metal actually available for delivery, fell from 84.9 million ounces in 2020 to 47.2 million ounces by early 2026. Nearly half the deliverable silver vanished in less than 5 years. JP Morgan could see the math. If industrial demand consumed all the surplus and investment demand simultaneously spiked, there wouldn't be enough physical silver to back the paper claims. The entire futures market would face a delivery crisis, and when that happens, the exchange implements cash settlement, position limits, or force majeure clauses, exactly what happened to the Hunt brothers in 1980 when they tried to corner silver. JP Morgan learned from that lesson. Don't fight the exchange. Become the exchange. Control the physical supply before the paper market breaks, then profit from both sides. Third, monetary policy shifted in ways that made holding short positions on precious metals suicidal. The Federal Reserve began cutting interest rates in late 2025 after holding them elevated for 2 years. Lower rates reduced the opportunity cost of holding non-yielding assets like gold and silver. Real yields, the return on bonds after inflation, turned negative. In that environment, precious metals become the logical safe haven. The dollar weakened throughout 2025 as the Fed pivoted to easing policy. A weaker dollar makes commodities priced in dollars cheaper for international buyers, increasing demand. And with central banks around the world buying record amounts of gold, 254 tons in the first 10 months of 2025 alone, it became clear that even official institutions were losing faith in dollar-denominated assets. JP Morgan read the macro landscape and realized their old strategy of suppressing metals to support the dollar system was no longer viable. The fundamentals had shifted too far. Better to abandon the defense and profit from the collapse. Fourth, geopolitical fractures made physical assets more valuable than financial claims. China announced export restrictions on silver in late 2025. Joining a growing list of commodities Beijing is limiting to secure domestic supply. When the second largest economy in the world starts hoarding strategic materials, that's a signal. The Shanghai Gold Exchange, where physical metal actually changes hands with real settlement, showed persistent premiums of 12% over London spot prices for months. In a functioning global market, arbitrage would close that gap immediately. The fact that it persisted meant there wasn't enough physical silver available in London to arbitrage, even at a 12% profit margin. JP Morgan saw that Eastern markets were already pricing in scarcity while Western paper markets were still pretending supply was abundant. They chose to position with the physical reality rather than the paper fiction. So, what does this mean for everyone else? Let me walk through the implications because this isn't just a fascinating market story. This changes the entire playbook for precious metals investing going forward. For retail investors who have been stacking physical silver for years, this is validation. The thesis that the market was manipulated and that physical metal would eventually decouple from paper prices is playing out exactly as predicted. JP Morgan's exit from the short side removed the primary force suppressing prices. With that pressure gone, silver rallied from $23 to over $80 in less than 2 years. If you held physical metal through that period, you more than tripled your money. But the bigger question is, what happens next? JP Morgan isn't accumulating 750 million ounces to flip it for a quick profit. They're positioning for a multi-year structural bull market driven by supply deficits that can't be solved with price increases alone. You can't mine silver fast enough to meet the combination of industrial demand and investment demand that's coming. For other banks and institutions still holding short positions, this is a nightmare. They're trapped. Covering their shorts means buying physical silver in a market where JP Morgan already owns most of the available supply. Every ounce they buy pushes the price higher, forcing them to buy more at even higher prices. It's a classic short squeeze, except the entity that could normally provide liquidity, JP Morgan, is on the other side of the trade now. Some of these institutions will fail, not publicly and not all at once, but there will be quiet bailouts, emergency Fed lending, and forced mergers to prevent visible collapses. We already saw $17.2 billion in emergency repo usage in December 2025. That's just the beginning. For industrial users of silver, electronics manufacturers, solar companies, automakers, this creates a serious problem. If one entity controls nearly a year's worth of global production, they effectively control pricing for the entire market. JP Morgan could charge whatever premium they want for physical delivery, and manufacturers would have to pay it or halt production. This is why some analysts believe JP Morgan's endgame isn't just profit, it's control. In a world transitioning to green energy and electric vehicles, silver becomes a strategic material as important as oil was in the 20th century. Whoever controls silver supply controls the pace of the energy transition. And there's a darker possibility that some market watchers are whispering about. What if JP Morgan's flip wasn't just about profit? What if it was about orchestrating the controlled demolition of the dollar-based financial system? Think about it. For decades, JP Morgan served as the unofficial guardian of dollar hegemony. They suppressed gold and silver prices to maintain confidence in fiat currency. They managed treasury auctions. They were the quintessential too-big-to-fail institution at the heart of the system. But what if they've concluded that system is ending regardless? What if they've decided to position for the next system rather than defend the dying one? Their accumulation of physical silver, their shift to net long positions, their relocation of metals trading operations to Singapore, these aren't the actions of a bank defending the status quo. These are the actions of a bank preparing for a fundamental restructuring of the global monetary system. Some analysts believe we're heading toward a world where currencies are at least partially backed by commodities again. Not a full gold standard, but a hybrid system where central banks hold significantly more gold and silver relative to their monetary base. In that scenario, whoever controls physical metal before the transition has enormous leverage in the new system. JP Morgan, with 750 million ounces of silver and unknown quantities of gold, would be perfectly positioned. They could effectively become the central bank for silver, able to lease metal to other institutions, set premiums, and influence monetary policy in the new regime. Is this conspiracy theory? Maybe, but it's conspiracy theory grounded in observable actions. JP Morgan didn't accumulate the world's largest private silver hoard by accident. They didn't flip from the largest short to net long on a hunch. They're executing a strategy, and the logical endpoint of that strategy is control over a critical monetary and industrial commodity in a post-dollar world. For individual investors, the question is simple. Do you want to be holding paper claims or physical assets when this transition happens? Because if JP Morgan is right about where this is headed, the difference between owning SLV shares and owning physical silver in your possession could be the difference between wealth and worthless receipts. Look, I'm not a financial advisor. I don't know your personal situation. I'm not telling you to buy anything or sell anything. I'm showing you what the smartest, most connected, most powerful financial institution in the world just did. They spent 15 years accumulating physical silver while manipulating prices lower. Then they flipped sides, went net long, and the price tripled in 18 months. They didn't do that because they think silver might go up 20%. They did it because they see a structural shortage that can't be fixed and a monetary system that's reaching its breaking point. When the bank that's been guarding the dollar for decades abandons that position and bets against the system they helped build, that's not a trade. That's a warning. The great betrayal isn't just that JP Morgan switched sides. It's that they left everyone else on the wrong side of the trade, holding paper promises in a market that's about to demand physical delivery. And when that delivery crisis hits, the paper price and the physical price will decouple permanently. We're not in the speculation phase anymore. We're in the documentation phase. And what the documents show is that JP Morgan knows something the rest of the market hasn't priced in yet. The only question is whether you're going to figure it out before the exits close.